So we're very pleased with our 2019 results that we've just published this morning. We've shown quite considerable growth in assets under management, up to £15.1 billion by the end of September. And that's actually grown further in the first 2 months of our new financial year, reaching £15.7 billion by the end of November 2019. The results have also reflected a nice uptick in revenue, and our IFRS profit before tax has grown quite considerably. We've seen a growth in shareholder equity. We've been able to pay off the remainder of the loan that we took around the time of the Pax World Management acquisition, and we're very pleased to report that the pipeline is looking very strong as well. So as the assets under management have grown and revenues have come through very nicely, then because we've been able to keep a lid on the growth in operating costs, then the margin has been quite strong, particularly in the London managed business, so the funds that we ran out of London. The scalability of the business model that we are really adamant on delivering has come through, and although we've seen the margin in New Hampshire back a little bit compared to 2018 because of the state of the US equity market at the end of calendar 2018, then that situation has improved quite considerably. So on a run rate basis, the operating margin's up quite strongly. So Impax's investment philosophy, which is that as the world transitions to a more sustainable economy, there's going to be great opportunities around improving resource efficiency, solving environmental problems, and coping with the stresses and strains that more and more people on the planet with increased urbanisation are leading to. Then we're seeing great growth opportunities in a large number of markets. So the switch towards clean energy, renewables as a dominant source of electric power, the transition towards electric vehicles, the search for substitutes for certain materials like plastics that are increasingly seen as socially unacceptable, the threats to the water supply coming from natural events, but also increased demand, are leading to business opportunities for a large number of companies that we're investing in. So from a sort of fundamental perspective, Impax is seeing great growth potential in our ability to find exciting companies, and if we put them together in sensibly run portfolios, we ought to be able to continue to generate investment outperformance relative to the market. Well, Impax's track record goes back more than 2 decades, and we're delighted that we've had a very stable team in that time period. And so our ability to demonstrate to sophisticated institutional investors around the world how robust our investment processes are in this sustainable economy is a great strength of the company. The fact that we now have research in 3 continents, so we've got a big team in London, we've got a team in the US, and we now have more than 10 years of experience in our Hong Kong team, means that we've got an ability to research markets and companies in our area right around the globe. So the size of the team is a real strength, as is the background of the individuals working in the team. I think we now have 10 scientists or engineers who are complementing those in the team who've got more generic skills around financial markets or economics. Our client service is also well established on an international basis, so we have more than 90% of our clients from outside the UK, and we've been working for 2 decades with distribution partners in many different geographies. So we're very well used to providing reporting and expertise around sort of product services to different client groups in different parts of the world. So we're managing money really in 3 areas: in listed equities, which is more than 80% of our assets under management, in private equity, and in fixed income. I'm very pleased to say that across the board our investment performance continues to be very strong relative to generic benchmarks and also to the environmental benchmarks that we use for our investment funds in the thematic area. So that investment performance really is derived from a set of robust investment processes that we continue to refine, and our teams work on a collegial basis, so we don't have a star manager culture. Well, in the context of a decarbonising power sector, then there is an increasing demand for renewable energy assets, wind power, solar power, hydropower, as well as in storage and also interconnection between one power grid and the next. And so, particularly in Europe, which is a very fragmented market, lots of different regulatory regimes, lots of different business cultures, lots of different types of utilities, then we're finding a really exciting pipeline of opportunities to back the developers of these new assets and to get assets built. So we can see the opportunity set growing really quite dramatically over the next decade, and we're certainly aspiring to manage more and more money in that area on a private basis. Well, broadly speaking, Impax is designed to scale, and we've put in place systems and processes that should be suitable for a much larger amount of assets under management. We also have plenty of additional capacity in most of our strategies that we're running today, and therefore the core of the Impax business plan is to scale up on the existing base, and that should drive operating margin to higher levels. Having said that, we're not averse to launching new strategies, and part of the rationale for the Pax World Management acquisition in 2018 was this ability to access expertise, particularly in smart beta and in fixed income. And as we've discussed in our market statements over the last couple of years, we've been actively building a plan to cross-sell between the New Hampshire business and the London business and tap into different client bases.
Yeah, the revenue has grown very healthily over the course of the year due to the strong growth in the assets under management, as Ian's already described. I think the main points to note are that last year was boosted by 6 million of one-off income related to the private equity business, so that of course is not repeating in the current year. But the two other main effects that have occurred in this year have been a 9 million increase in revenue arising in the London side of the business due to the growth in assets for the listed equity business. And in New Hampshire, we have an annualisation effect. Last year included 8.5 months, whereas this year we've now got 12 months. So those really are the main drivers behind the story. That means that in total we've now got a run rate revenue of 78 million as of the end of September, and we've made a very good start to the current year as well. Costs have increased over the period. Two main drivers for that. In the London side of the business, the costs have gone up to support the growth of the business, both in terms of staff costs, which is our main cost for a business such as ours, and on the non-staff side as well. In New Hampshire, we've again got the effect of the annualisation, which again takes up to 12 months. So those are the main drivers. What's interesting is if you compare that increase to the increase in revenue, then the headcount has gone up by about 6 people, about 6% I should say, whereas revenue has gone up by double that, demonstrating that there's a strong scalability within the business. Overall, at the end of September, the run rate operating margin was 26%, and that is set to rise further if we're able to bring in additional revenues. Earnings per share again benefited last year in terms of the one-off private equity income. So if you strip that out, then the earnings per share has increased, primarily due to the strong contribution from the London business, and again including the full year effect of New Hampshire. So overall we're now producing 11.5 pence for the year 2019. The board has followed a progressive dividend policy for the last 10 years, and this year pleased to announce a 4 pence final dividend, which is 5.5 in total, 34% up on the prior year. We've also signalled that at some point we'll be coming back and reviewing the policy, and pleased to announce that today, and are signalling that in future we intend to move to a payout range of between 55 and 80% of adjusted profits after tax, which is now appropriate for a firm such as ours with a strong balance sheet and strong growth prospects in the future. The cash has risen over the period. This is primarily due to the very strong cash generation. The profitability pretty much falls through to cash flow. During the period we paid off the debt that we took on as part of the New Hampshire acquisition, paid out final dividends, and also bought back a number of shares in the market consistently with our buyback program to mitigate the effect of share awards. So overall this left us with 26 million of cash, plus another 4 million sitting on the balance sheet in terms of seed investments in our own funds. That 26 million we regard as entirely adequate to run the business. Taking off a risk buffer, which we typically earmark as part of the balance at the end of at any point in time, leaves 20 million of cash available to be used within the business. And when one earmarks specific upcoming payments, for example the final dividend, that leaves a balance of 10 million available for other purposes, which is sufficient for things like buybacks, additional seeding, etc. So a strong position. So the register is carefully managed through this buyback program and the flexibility we have in terms of issuing awards where we choose to do so. At the end of September, 46% of the shares were in free float and 30% were sitting with management.
I think the investment management industry is increasingly showing signs of a split. So the large managers who've got a wide range of strategies, but also a lot of passively managed money, are growing and attracting more clients. But at the same time, there's scope for boutiques to offer something which is differentiated. And Impax is really well placed in that second category. Our investment philosophy around the transition to a more sustainable economy, leading to strong signs of outperformance and strong prospects for alpha, if you like, is well founded on a number of very strong drivers around population dynamics and the fundamental opportunity to make money, and the fact that we've got a 20-year track record, a brand which is globally recognised, and clients and client interest in lots of different parts of the world mean that we're well placed for expansion on a diversified basis, given our strong foundations and a scalable business model.